What's going on, everyone? Jeremy here. I am back. I know I've been gone for weeks. I've only done a couple videos in the last, 6 weeks or so, and mainly that was because I've been healing after my hip replacement. If you saw my one video where I was explaining where I've been, yes, I've had a hip replacement, and quite honestly, it's really hard to get in front of a camera and try to be all chipper when you're in a lot of pain and you're just uncomfortable. So anyway, I'm starting to feel like my old self again, so I am back. I'm definitely going to try to get back to at least a couple videos a week. That being said, today I want to talk about what I consider to be a win-win situation. But before I do, if you could smash that like button and please consider subscribing if you haven't yet. So jumping right into what I'm talking about, if anyone has at least 100 shares of any stock, has to be an actual company, can't really be a mutual fund or a closed-ended fund, unfortunately. But that being said, if you have 100 shares and it's a big company that's traded a lot, meaning it has a lot of volume behind it, you're going to have more options, so to speak, on doing this technique. And this technique being covered calls. Now, I avoided options for years. My dad was always trying to get me to get into options a little bit because I've always had a pretty good sized portfolio. I've had most of my money in the stock market over the last few years. And, he was always talking about, you got to get into options. He didn't know, it had been years since he had done some options. And, his health was ailing and he wasn't really able to show me that much stuff. But in recent history, I've really gotten into options. It's really easy to figure out if you start off slow. And I think the covered call is a great place to start. So let me give you a scenario. Let's say you have 100 shares of Bank of America. Now this is an option spread of Bank of America. If we look right up here, we can see the closing price of its last trading day, which was this last Friday, was $40.45. Well, if we go to the call side, if you look over here, we've got calls and puts. We're not going to play around with puts. I'm going to explain all that, I promise, in some future videos. But for right now, don't want to overload anyone, especially if you're completely new to options. This is a great, literally a win-win situation. It can be if done right. Worst case scenario, you make money. Trust me, these are awesome. So anyway, let's take a look at this. We're going to go to calls. We know that the closing price was $40.45. So it's floating around that area. If you see this, there's a little line right here, and it's basically showing the prices, the strike prices, above and below its current price. Now, what I said earlier, as long as the stock is a pretty big company, it's got some volume of options trading behind it, you're going to have possibly weekly options. For the most part, every company is going to have an option for at least once a month, and then stuff that's really liquid like Triple Q, QQQ, Nasdaq 100, and SPY, the S&P 500. You've got options like literally a few times a week. It's happening like literally every other day. There's options all the time. But what we're going to look at is a good way to think of a covered call is I don't think the stock is going to get above this price. Now, when you do a contract for that, you're going to get paid a premium up front. For instance, if it's at $40.45, now I can look at a chart, see where it's been, see what kind of resistance levels it's been hitting, see levels that it hasn't even hit yet for the year maybe. You could go to those levels. They're going to pay a lower premium. Basically, the better your odds of succeeding, the less premium you're going to get. If you want to take more of, I hate to use the word gamble, but if you want to take more of a gamble and say, I hope it doesn't get over this price, you're going to get a higher premium. That being said, if it's at $40.45 right now, we could look at the $41 strike price. And as of right now, considering I'm filming this on a Saturday, so the market's closed, these numbers are going to fluctuate throughout the day. The $41 strike price, which you could be basically saying, I don't think it's going to get over $41, is going to pay anywhere from 32 to 35 cents. That's the bid and the ask. So right in between there is the realistic price you could get. So we could say between 32 and 35, you'll probably get about 33 cents per contract. Now, one contract is worth 100 shares. So you're going to get, like I said, 32 to 35 cents per share, and you have to have 100 shares. So that being said, you're going to get at least minimum $32 for taking on this contract. Now, that's per 100 shares. So like right now, I've got exactly 600 shares of Bank of America. If I were to do 6 contracts, that's going to be $32 times 6, so pushing almost $200. Now, here's how you make it a win-win situation. Don't hit a strike price if you are not comfortable with selling it at that price. For instance, if you really want to make sure that you don't sell that stock, you want to hold on to that stock, but you still want to make premium from stock. Remember, it's stock that you own. You have to own stock to do a covered call. You don't have to own it to do a naked call. I'll do a whole video on that later on. But for a covered call, you have to own at least 100 shares of stock per one contract, per one option contract. So let's say you really don't want to sell it, so you're going to put it at a higher price point. So if we look at the $42 strike, it's paying between 9 and 10 cents. Realistically, you're going to get 9 cents a share for that. So 9 times 100, you're going to get $9. Well, you might think, well, $9, that's not a lot. But this contract is for the September 24th contract date. So literally next Friday. So that's 5 trading days that you have to basically hold out to. Now, the further out you go, this is really important. The further out you go, let's start looking at the premiums if we go out 2 weeks. If we go to the October 1st, if we look at the $42 strike price again, that more than doubled. It went from 9 cents to 23 cents. And that's 23 on the bid, 26 on the ask, which means you're going to get closer to 24 or maybe even 25 cents. So, you know, you're over 100% more premium that you're getting to do this contract. Now, the caveat is you're giving the stock more time to climb up. So you gotta kind of figure out what your threshold is of what are you happy with if it were to sell. You know, worst case scenario is you own the stock higher. Let's say you own it at $44 and you're selling it at $42. That would not be good. But depending on how far out you go, the further out you go, the higher the premium. So you could still actually make money by selling a stock at a lower price if you're getting compensated more. The difference, this is probably very confusing, if the premium you're making is more than your loss for selling the stock at a lower price, you could still make more money. And this is a fantastic way to, if you have money, to unbury yourself. I'll use an example of what I did relatively recently with MasterCard. I had to choke up another $20,000, but I did a covered call order, sold the stock at a lower price, but my premium that I got from the option itself offset that, and I still made a couple $100 profit. And it freed up oh, I don't know, almost $35,000 for me, which is nice. So something else, I'm right down here on the screen, I've got Strategy Builder on here. When you're doing some more advanced option spreads, one thing to consider is the delta. If you really want to hold on to the stock, delta can be a very good thing to look at. Let's say we look at the $42 strike price on this. It's at a 0.8 standard deviation, which is not that high. A lot of people are going to go for at least a 1 deviation. I love to do strangles. I'll get into all that later with a 2 deviation, and that puts my delta usually at like, well, here we'll hit it. Okay, don't have exactly 2. We got a 1.9 and a 2.1. We're going to do a $44 strike price. I'm going to click on that. It's going to load it into here. Now, if we look at the delta, there we go, 0.048. So when I'm looking at that delta number, 0.048, there's a couple ways to look at that. Delta, traditionally, that means for every dollar that the stock is going to move, that option is going to move basically 4.8 cents per dollar it moves. So the higher the premium, the higher the delta number. Now, another way to look at delta, I look at it this way. I already know how much it's going to move by looking at the premium. So the higher the premium, if it starts to go against you, it's going to start to go against you very quickly. So a smaller contract is much safer if it doesn't work out for you. In this case, though, it's not going to go against you. Worst case scenario is you're going to sell the stock at a not the best price. Let's say if it blows past that price, you could have held it longer and then sold it later. But if you include the premium, maybe you still made more money. So what I recommend with this is set it at a price where if it were to trigger, meaning go in the money, you're going to be happy either way, because you're getting paid a premium to do the contract, and you're getting paid, hopefully you own the stock lower than what you're selling it at. And at that case, you just made money twice, so be happy. Could you maybe have made more if it blew past that strike price? Perhaps, but anyway, back to delta. Another way to look at delta is, let's say it's at 0.048. So in percentage terms, that's 4.8%. That's a little less than 5%. Let's just round it up to 5%. Another way to look at that is you have a 5% chance of being in the money. In the money is not what you want with options. In the money means you're in that zone of your strike price. Like you have reached that strike price and beyond. You want to be out of the money. So what's the reverse of 5% out of 100? 95. So if you went with like basically a standard 2 deviation move, will typically put you at about a 95% success rate, give or take. You might have to adjust the strike price a little bit, but now the problem is the premium with a 2 deviation move is not high. So you usually have to do some, you have to trade with some volume. But let's say you're going out further, you can go safer by doing a higher strike price, meaning a higher deviation. So like for instance, this 44 is 1.9 standard deviations. It's as close as I can get to 2 without going over 2, because the next option is 2.1 on this option spread. So if we look at this, it pays 4 to 6 cents per contract per share. If we go out to the 8th, same strike price, it just now doubled, went 9 to 11. If we go out almost a month, 19 to 21. You see what's happening? So we're able to go out. If we're able to go out further, we're going to get a higher premium. Now, there's pros and cons, obviously, to this, especially if you're doing strangles, especially if you're doing, you're shorting a put or selling a put. I'll get into that all in another video, but right now, just talking about calls. If it's a stock that I think this is a good rule of thumb. If it's a stock that you really don't want to sell, I would go out on a further time frame, a month, maybe 2 months, somewhere in between there, and go for a higher deviation number, like, a 2 deviation. And worst case scenario, as long as you own that stock under that strike price, you're going to get a fat premium, and it's going to sell your stock at that strike price. That's the worst case scenario, as long as you own the stock lower than the strike price. So, you'll be making money from the premium, and you'll be making money from selling the stock. Now, you should be able to do covered calls with any broker. There's so many examples of doing this with Robinhood. Quite honestly, Robinhood has a pretty slick interface. In fact, let me show you real quick. Okay, so now once you've opened up, if any of you guys have a brokerage with, I almost said Apple, with Robinhood, you can apply for options. Actually, they'll approve you too quickly, in my opinion. But I'm just using Apple. I'm using Robinhood as an example because, quite honestly, it is a pretty slick interface. And a lot of times I'll be laying in bed and I'm just looking at different option spreads just to see what they pay. If I don't feel like walking my butt down to my office. So anyway, if we take a look at Apple and you hit trade, if you are approved for options trading, you'll see right above where it says buy, it says trade options. And it just gives you a quick little, explanation of, I think it's going up, I think it's going down, yada, yada, yada. At the top of the screen, it's going to give you different dates. Now, Apple is obviously a very popular stock. It has options every single week. So if we went out, let's go 2 weeks out just to take a look. If we go to October 1st, let's say you have 100 shares of Apple. You want to make sure, this is something else I did not say yet. When you do a covered call, really, really important, make sure you have sell. Do not have buy. This is a completely different thing. You want to hit sell and call with whatever broker you're using. If you were to buy a call, that could be really bad if the stock were to go down. Hopefully it would work out for you, but I never do buy calls because you're basically, I'm not going to get into what buying a call is, but it's a very bullish move. You're hoping that that stock is going to go up, and you can lose a lot of money. Just look at most of the degenerates. I hate to use that word, but degenerates with Wall Street bets. But anyway, I digress. Let's go back to this these different strike prices. So we got Apple. This is 2 weeks out, and you can just slide from the left to the right and get some different time frames to take a look at. If we look at the share price, it's going to show right in the middle of the screen. It closed at 145.76. So let's say you own at least 100 shares of Apple, and you own it at, I don't know, 140 bucks, let's say. And you're like, I'd be okay if I were to sell it, but let's see if I could make a profit. So let's say you're like, let's see if it would hit $147 strike price is going to pay you $217 roughly. This is just an average price, $217 per share. you're going to get $217 just for taking that contract. If you notice, it says minus 40.55%. That is because when this contract, when these numbers were, how can I explain this best? When the stock price closed, it closed down. And when you are trying to do a contract that is above the prices for those contracts are going to go down. So a good way to maximize on this is sell a call order when the stock price is going up, or it's what you think is at least the high of the day. If you do one of these orders when the stock price is down, the contract will not be worth as much. If you look on an options screen, like with a real brokerage, what I was showing you guys before is my big account. This is my Interactive Brokers account. So when you click on one of these strike prices, it can take you to a screen that is trading. It looks just like any normal stock chart. Well, not any normal stock chart. The volume is not nearly as high. So, but anyway, you can basically see the bid and ask prices are fluctuating throughout the day. So if you're doing a covered call and you want the maximum amount, you want to get it when the stock price is higher. And basically the way I kind of forgot another thing I needed to explain is you want this contract. If let's say you do a contract at 40 cents, that's what the contract says, it's 40 cents. Well, that's 40 cents times 100 shares. So that's worth $40. You might see later in the day, that next day, whatever, you might see the value of that go from 40 to 45 cents, or even 50 or 60 or whatever. That's going against you. Don't panic. That just means that in order to close a covered call, you're at a negative position. So you would, if you have one contract, it's going to show you have minus one contract. So you would just buy that back. But you want to buy it back since this is a shorting position. You want to buy that back at a lower price. Eventually, you want the contract to expire worthless. I remember hearing this before, and I'm thinking, you want it to expire worthless. Well, that's not a good explanation. You want it to expire worthless after you've already gotten paid your premium. So it's expiring worthless. That's a good thing. If it's expiring and it's worth more than what you paid for as far as on a dollar amount, then you're upside down. It didn't work. But that's not going to happen with a covered call order, because it will go to worthlessness. The worst case scenario is you're just going to be assigned, meaning it's going to sell you at that strike price. But keep in mind, all option contracts eventually go to zero. They're going to be worth nothing. But the problem is where that expired, basically. Did it expire in the money or out of the money? If it expired in the money on a covered call, again, that means that it hit the strike price, so you're going to be forced to sell at whatever strike price that you chose. So you want it to expire out of the money. I hope all this makes sense. I know it can be kind of complicated. Not to beat a dead horse, but just to kind of go over it real quick. Covered call, make sure you have at least 100 shares, and you're setting it at a strike price that is above its current price, and hopefully above the price that you own it at. And in my opinion, a good way to do a covered call is I'm going to set it at a price that if it were to trigger, I'm okay with that. I'm okay selling the stock. If you're not okay, set it at a price that's, far enough where you're going to make some money, but far enough where it's not going to get sold. Like I said, as long as you own it under that strike price, it's always a win-win. You're getting paid on the premium, and you're getting paid to sell your, you're not getting paid to sell, you're getting paid the profit that you're making for selling those shares. And just remember, you want to sell a call order. Don't buy a call order. Completely different. And real quick, I just want to say I have covered call options on all of my long-term, my REITs, a lot of my MLPs, my oil companies. Now, some of these are not highly traded, so there's not a lot of options. There's like one every month. And some of the options, as you could say, they're not that great. So might have to go out the next month because let's say the strike price exists, but it's worth nothing. Like you'll see a bid price of one penny, which means you're going to make $1. Keep in mind also commissions. That's one nice thing about Robinhood is they're not going to charge you any commission on doing a covered call. Unfortunately, I can't remember what I'm getting. What I'm charging, getting charged. My God, I swear to God, I can talk. I think I'm paying like 65 cents per contract, so it's not that bad. But keep in mind, if you do something that you're only making a couple dollars and you're getting charged 65 cents, well, they just took 1/3 of of what your profit's going to be in commission alone. So keep that in mind. Anyway, I'm going to shut up now. I know this was a lot to digest. If you're not new to covered calls, you're like, yeah, I know how this works, yada yada. This is like really elementary stuff as far as options, but there's a lot of my friends, I talk about options and they're just like, huh, okay, that sounds pretty cool, but how do I do it? So I highly recommend everybody that has at least 100 shares does covered calls to make extra income. And again, this works fantastic with stocks that pay dividend. My channel is all about dividend growth, dividend income. So, you know, you've got like ABR or something that's paying anywhere from 7 to 8% a year in dividends, and that stock has grown, I think, over 130% in the last 5 years. To put on top of that some covered calls every month or two, you're just making extra money. So it's, in my opinion, a win-win. So thank you so much for watching. Please hit me up in the comments if you have any questions whatsoever. I hope I did not miss anything. I know I did a lot of talking. That doesn't mean that I remembered everything. So hopefully I did. Please hit me up with any questions. I'm here to help you guys. So thank you so much for watching. Please like, share, and subscribe if you found any value in this, and I will see you hopefully very soon. Bye-bye.